Okay, I'm gonna get started. Oh, I did. Thank you. So I'm gonna do a quick recap, kind of take a couple minutes, step back into last class, and cover up the investment banking process, and then we'll, provided we have time, we'll start rolling into time value and money today. But I want to finish up the investment banking process and some of the structural things around financial markets. So we talked about the role of the investment banker last time. Actually, before I dive in, does anyone have any questions coming off of the last couple classes and the last couple quizzes that you want to cover here before I dive in? Okay, because I'm late today, I'm going to count everybody as present. I'm not going to take attendance. Just save 5 minutes or 3 minutes. So today would have been the day to skip class. Thank you for not doing so. Time value of money. Okay, you're paying for it. You might as well be here. Some cost. Okay, investment bankers. When we talked about last time, we talked about the roles of some of the intermediaries and the roles of the financial markets in capital raising and how we kind of match net savers with net borrowers, or folks who have excess money and folks who need money, and get them married together so that it's a win-win situation. And we talked about the role of the investment banker. Because the investment banker is the person, they're the intermediary that essentially they work with companies. So you guys can't go out and hire your own investment banker unless you got a company. But they work with companies to design securities, identify markets to sell those securities to, whether it's bonds, stocks, or preferred stock, and that's basically your three big buckets, and facilitate that transaction. They don't do this for free. And there's a couple ways that they make money. We talked about the first one on Monday, which is they buy the securities from the company. So they go, okay, well, we're going to guarantee to you, as opposed to a best efforts where they just go, well, we'll see what we can do. A lot of times the investment bank goes, we're going to guarantee you $20 a share. We're going to buy 1 million shares, $20 a share. Here's your $20 million. Then they resell them. Do you think they resell them for $20 a share? Not if they can get away with it. They're going to try and sell them for 21, 22, 30, 40, 50. So the folks who tend to make money on an initial public offering when a stock goes out are who? The investment banker and who else? The insiders who bought at $20 a share. So companies have tended to go, you know, we look at Dutch auction, or we look at a couple other methodologies to be able to maximize our share price value, or our share price when we go public, because you're really leaving money on the table in many cases, and we're giving it to the investment banker. Yes, sir.
So for IPO, where these investment bankers are probably having their best. So in a situation like Facebook, when it went public at $40 and then settled at $20 in less than a week, how does that turn out in this situation?
So they may not have had their best day ever on stocks that go like this, or that fall from the original offering point. However, they're not going to be out of money, because what will end up happening is they also take a commission to handle that sale, or they sold into the market on day one at 40, and then the stock starts going down. They're not sitting on that stock anymore. They've sold it day one, or they've sold it, if they see it's going down, they sold it day 1, 2, 3. But Facebook, and I'd have to get into the details, more recently, and Facebook was a relatively recent IPO, they've gone to this Dutch auction process where really that bid-ask spread that I showed up there, where the investment bankers buy at a lower price and sell at a higher price. Companies have gotten smart to that, and so they've forced pricing to be closer to what they expect the market to be, and shifted the money that's getting pocketed from the investment banker back into the company by running either Dutch auctions or, basically going, well, you give me 45, 40, 35, 30, and as soon as they get a market clearing price, they dump it out rather than going, well, I'm going to put it in at 20 knowing it should go higher. So I'll look at Facebook though, and on Friday, I'll see if I have a better answer for you for that specific example. We talked about this first stage for investment banking, which is really the what are you going to do? And some of this gets done by the company and management, so by you guys prior to the company going public, and some of it gets done by the investment bankers after you've chosen the investment banker. And the selection of an investment banker, as we talked about, is pretty important. They're going to be partnering with you for probably the better part of a year to go through your securities offering. So you're going to want an investment bank that is both specialized in either the industry that you're working in or the type of security that you're selling. And you're going to want to run a competitive bid process for the investment bank. So you don't want to just, investment banks, when you guys get into management, investment banks will troll you and essentially call you up and either harass you to give them your business or tell you how good or how bad your company is and how they can help. And it's a sales process. Investment bankers are finance people who are salespeople. In many cases, they're more salespeople than finance people. So if you enter into an investment banking relationship, make sure you run a competitive bid process and get somebody good. Don't just pick up the phone and take the first call you get, because it's not likely to be the best one. Once you've gotten into that and you've chosen the investment bank and you know what you're going to be looking for, you've got these stage 2 decisions, which is, so you've probably gone through a 3-month period of this discernment process around who should we hire, what should we do, what money should we raise, and then you are going to make sure you've got the right answer before you kind of roll through the rest of this process. This gets extremely expensive. You're going to have fees to the investment bankers, they're going to have commissions, you're going to have legal costs, you're going to have accounting costs. An initial public offering is going to cost you in millions of dollars in cost just to put your stock out there. So you want to make sure before you pull the trigger and you're actually going to go with it that it's going to work. So you've got these 2 components, and we talked about this a minute ago. Best efforts or underwritten. So best efforts essentially is the investment banker agrees to take on the process of marketing your stock, but there's no guarantee that it's going to be sold and no guarantee at what price. Do you think the fee here is going to be high or low? High. Why? There's no guarantee for them either. And so they're going to be going, okay, look, we'll do best efforts, but it's going to be a 10%, 15% potential commission on this stuff because we're not really sure. They'll do best efforts. If they're not really sure what it's going to sell for, you're not really sure what it's going to sell for, your company's not really that strong, that's where you tend to get best efforts because they don't know whether the market's going to be there or not. They'll market it. And a lot of times it's shared, and we're going to walk through what that fee structure tends to look like, but you're going to pay a pretty high commission on it. An underwritten arrangement, they guarantee the sale. So they've done the market analysis, they look at your business, and they guarantee the sale. So what do you think the commission structure on this is going to look like? Lower. Where do you think they're going to make additional money? The bid-ask spread. Essentially, they're going to buy low, sell high. So this is going to look cheaper because they're going to go, okay, I'm going to give you, instead of 10% here, I might give you 3% here. So 3% of the cost. But you're also going to have a bid-ask spread. They're going to take some money and leave it on the table because they're guaranteeing the sale. As I mentioned, you got these issuance or flotation costs. They're high. I think the book talks, a couple $100,000 here, a couple $100,000 there, and the examples, it's millions. You start getting attorneys involved, and I have a soft spot in my heart for attorneys. You start getting attorneys involved, and they rack up fees. You get accountants involved, they rack up fees. You're going to get marketing people and other consultants involved to try and figure out the market and figure out who the investment banker should be. They rack up fees. Then you've got the investment banking fees. And so by the time you're done, it's fee city, and you're going to be out 7 figures. And if it's a best efforts, you're out the 7 figures whether it works or not. You've got SEC filings, you've got all that stuff has to happen before you raise your first dollar. The other thing that happens is you set the offering price. When markets are hot, offering prices tend to be easy to set. Sometimes the market goes soft. And so you're going through this process. This may take a year from stage 1 through to setting the offering price. You're rolling through this process. You're spending money. You've chosen your investment banker. You're burning a bunch of time and resources. You go to set the offering price, and the offering price is low. You thought it was going to be 20 bucks a share. The investment bankers in the market are telling you it's going to be 12. What do you do as a management team? Do you go forward with it at 60% of what you thought the price was going to be? Or do you pull the offering? If you pull the offering, all the money you just spent, you end up, if you decide to do it again in a year, you're spending almost all that money again. If you move forward, you're leaving a bunch of money you thought that you were going to get on the table, or at least the market's not ready for it. I'm going to ask a hypothetical question. We're finance folks here, at least in this class. You've just spent $1.5 million to get yourself ready for the IPO, and the market's saying it's going to be 60% of what you thought it was going to be. How important is that $1.5 million that you just spent? How important is that to your decision as to whether to proceed or not? It's not a hypothetical question, that's a question.
It depends on the value of what you were expecting. If you were expecting 20 bucks a share, you get 12, and you're selling 100 million shares, and that's a lot more than $1 million.
Okay. Any other comments?
How much of a percentage is that of the net worth?
Let's say it's 25%. Which is pretty typical for an IPO. It's about a 25 to 30% float.
I mean,
Oh, the $1.5 million?
Yeah.
Oh, let's say that's 2%.
Depends on how much you need.
It doesn't matter. Anybody know why it doesn't matter? Sunk cost. You've already spent it. And what we're worried about in finance is what's going to happen in the future. What's my cash flow that's going to come in the future? And if you go, hey, the present value, and we're going to talk about this today, later, but I'm starting to tee it up on how this works. The present value, the amount of money I expect to get in the future, if I wait a year and a half, and I do it now, I want the higher of the two, factoring in that I'm waiting a year and a half for the money. So if I go, okay, I can get 12 bucks a share now, I can get $20 a share in a year and a half, I'm going to have to spend another $1.5 million over here. There's a methodologies, when we hit capital budgeting, you're going to see how to do it, where you actually analyze this, you analyze this, which is not, the $1.5 million already spent, so that's out. It's really what's the cash can I get today versus what's the cash can I get tomorrow, the net cash. Which one's higher, accounting for the fact that I've got a delay in receipt. And so that $1.5 million you just spent doesn't matter. That's a sunk cost. You've spent it whether you do it or not. It's now really trying to figure out which is going to be the better decision, to wait or to do it now based upon time value of money principles. And we're going to talk about that later. So here's the investment banking process. This is the cost. Again, I laugh at this because it's so small. So an investment bank ain't going to do a $470,000 or $500,000. They don't look at things that are right now probably less than 10 million. But we'll use this example because it's easy. Net proceeds and flotation costs. Flotation costs are the commission that the investment bank is going to charge. Net proceeds are what goes into the bank. So in this particular case, and this is why those stage 1, stage 2 decisions are important, we're trying to figure out how much money do we really need. So if we go, we need $470,000 and flotation costs are 6%. It's a pretty straightforward analysis to go, 470,000 is what I need in the bank. I'm going to get 94% of the total because the investment bank's going to rip off 6% for rip off. He's going to take 6% for their commission, so I need to raise 500,000. So I'm going to sell $500,000 worth of stock. I'm putting 470,000 in my pocket. That's why this is important. The cost could be pretty high. You know, if you're talking 10%, you're now going to have to raise 530,000, 540,000. So you've got to have a handle on these costs, and if you're going to go to market, you got to realize that you've got a commission on top of all the fees, and you're going to be spending legal to do all the placement work. And so when you're thinking about, when you look at a company and they go, they raised $20 billion or $15 billion, or Facebook raised $100 billion in an initial public offering, how much of that money went into the company's coffers? If it was a $100 million offering and it was a relatively large company, probably only 97 million or 96 million went into the company's coffers. 4 million went off to the investment banker, plus anything they made on the bid-ask spread. So here's how investment banks work. There's this underwriting syndicate and a lead underwriter. The lead underwriter is the investment bank that has a primary relationship with the company. So I'll use a real world example that, you know, is pretty typical. So when one of the companies I worked for went out to market, we had as our lead underwriter Keith Bretton Woods, which is a specialty investment bank in New York. And KBW essentially said, look, we know this industry better than anybody else. We can help position your company. We know the buyers. They were the lead underwriter. They managed the relationship with us as a client. They also managed the relationship with the syndicate. So Keith Bretton Woods said, you know, you're going to be raising $100 million. We don't want to take all that ourselves. You know, we're going to do a guarantee, but we don't want to put $100 million on our books and then take the risk that we're not going to be able to offload it. It's a big chunk of change for a small bank. So what they said was, we're going to include as a syndicate Goldman Sachs and JP Morgan. So it's Keith Bretton as the lead, Goldman Sachs and JP Morgan as participants. And so you had essentially these three investment banks. We dealt only with, or predominantly with, KBW, but you had other investment banks who were part of the syndicate. And so what happened was KBW said, okay, of the $100 million we're raising, we're going to be in for 50, Goldman's in for 25, Chase is in for 25, and that's where the 100 comes in. From the company's perspective, we dealt with one of those, and then KBW dealt with the rest. What ends up happening there is when that commission split comes out, that 6% that you saw on the last page, KBW may take 4%, and each of the other participants take 1% apiece. So the manager gets a management fee, and that's negotiated between the underwriter, the lead underwriter, and the syndicate participants. Then you've got a selling group. In a selling group, you essentially have brokers, and you know there's some movies like Boiler Room that kind of are like how this works. Where these folks, Chase will go, okay, now I've got $25 million worth of Beeline stock in this particular case. I've got to offload that somewhere else. I'm not going to sit on it. So I'm going to turn around and start working the phones because I've got insurance companies, pension funds, folks who are then going to be buying this stock, or I'm going to flush it into the market. But I want to make sure on the backside of that. So I'm going to be, you know, I'm Chase and I want to make money on this. I bought it at 25 million. I want to sell it at 35 million. I want to make sure it's going to be a public offering. I want to make sure that there's interest in the market. So I'm going to be getting brokers involved to talk up the stock, to be able to take pre-orders, to make sure that the market's ready to go when the offering hits. Or I'm going to take it off my books and use these folks to flush it through into the market through intermediaries like pension funds, insurance companies, and mutual funds and other institutional investors. It would be very difficult for an independent company to do all that. That's why the investment bankers are important. And it's a complex process because you've got that SEC regulation, Securities and Exchange Commission regulation, overseeing the entire process. And so as a result, you really can't just do it yourself. In theory, there's ways to do it yourself for small offerings, but as a normal practice, you can't do all those steps yourself in-house. You hire an investment banker. The last thing on investment banking that I want to really touch on is this shelf registration. Shelf registration is essentially you go through the process. So you're not sure. I use that scenario. Do you do it now or do you do it in 18 months? If you're going through that stage 1, stage 2 discernment process, you go, I don't really know what's going to happen, but we want to be ready to go when the market turns. You do a shelf registration, which is essentially put in all the legal work and you leave some dates blank. You do all the pre-work that you can and you file with the SEC going, as soon we're ready to go. And we'll continue to update this quarter over quarter over quarter. But when the market turns, we can be in the market like that, as opposed to having to start all over from scratch and then redo all your disclosures, redo all your filings with the SEC, and then go back into the market. So a lot of times you get this, what you'll see is a shelf registration. You look on EDGAR, which is kind of one of the things that we'll probably touch on here shortly. You look at EDGAR and you go, okay, we talked about it earlier. You go, okay, there's a bunch of companies in here that said they're going to be public and they filed 8Ks or they filed F14s or S1s, which are various filing types, proxies, mandatory disclosures, and initial public offering documents, but their stock's not trading. And they keep updating them every quarter. Those are shelf registrations that are basically just waiting for the market to turn, and then they're going to go ahead and issue the stock. There we go. There's a number of other financial intermediaries that you're going to deal with, and that if you're in a company are likely to either invest in you or lend money. So commercial banks, credit unions, and savings and loans, what do those, if you're a company, what do those predominantly do? If you're a manufacturer, as opposed to being one of those things, what's their primary purpose? What kind of capital? Cash, yes. These are all going to provide cash at some level, but what kind of capital are these guys going to provide? These are banks, essentially, they're going to provide loans. They invest in loan pools. Commercial banks predominantly invest in commercial loans, C&I loans, commercial industrial loans. Credit unions normally don't deal with businesses, large businesses, they deal with people. They're owned by their members. And they'll make small business loans. Savings and loan associations traditionally made housing and mortgage loans and business and land loans, business property and land loans. Most of these savings and loan associations have gone away. They're now commercial banks. Mutual funds, whole life insurance company, and pension funds, what do those invest in? A 401k is a type of pension fund. What do they invest in? Yeah, it's retirement. Think about what are they? Yes, sir. Yeah, so what you've got here is mutual funds will tend to invest in stocks and bonds. Whole life insurance companies invest in all sorts of stuff. They have buildings, these guys will invest, these last two will invest in pretty much anything that will return money. They'll hold hard assets like office parks, housing developments, apartment buildings, do stocks, bonds, and CDs. A lot of times when you're looking at who owns stock, who owns bonds, who are the investment bankers actually trying to sell or place this stuff to, it's to one of these folks. There's trillions of dollars that are invested between pension funds, which include your 401ks, 403bs, IRAs, that are family investments, whole life insurance companies, which is you buy life insurance and there's a cash value associated with it that's invested, and mutual funds, which are essentially groups of investors that buy groups of stock. Most of the stock market is invested by, is the primary investment is by these folks. There's not a lot of people who sit there and, I own 150 shares of US Bank. Most of US Bank is owned by these three categories. These folks will tend to invest in loan pools and securitizations of loans. The financial intermediaries, their job, as we've talked about, is to take net savers and net borrowers and put them together and facilitate those transactions because they have a disequilibrium of information. The financial intermediary knows more about the borrower than any individual can know, and the individual will be able to have a better relationship, and a lot of those intermediaries are diversified and or federally guaranteed to be able to limit the risk. And so they look at what does the market need, what does the borrower need, what does the saver need, design products, CDs, securitized loan obligations, mutual funds, stocks, bonds, etc., and put them together and go, okay, this is what it's going to look like. We're going to sell them off to you. Normally, the role of a bank, and if you take BA 311, you'll spend a significant time on it. The role of a bank or any of those other intermediaries is they diversify your portfolio cheaply. It's far harder for any of us to go buy 2,000 different stocks and have a fully diversified portfolio. You can buy one share of a mutual fund and you're buying a small fraction of 2,000 stocks. And so the financial intermediaries diversify. If I'm going to make a loan, I can make a loan to you, and I'm solely reliant on your ability to repay. If I put my money in the bank and they pay me interest, I'm making a loan to the bank. The bank then makes a loan to thousands of other people. The chances are all the thousands of other people aren't going to not be able to repay, so I'm likely to get my money back. And it's those financial intermediaries provide diversification for your investments. So you can see we've talked about diversification, reduced costs, because it's a lot of money to do that work on your own. Funds divisibility and pooling. Essentially, you can split it up between various investments, and it would be very difficult to do that if you had minimum investment of $20 million for an apartment complex, for instance. Flexibility, because they create markets, you can get in and out. And they also offer related services. So you can get your credit card at the bank. You can get, a car loan. You can get your checking account. You can get a savings account. You can do all sorts of other stuff at the bank. So it creates this one-stop shop. Most of us, when we go to a bank and we use the bank, if we still use banks, a lot of us do all of our stuff at one bank. Because it's easy. You got your online banking. You go, okay, I could pay my credit card. I could transfer this. I could do that. I could do it all online. I don't have to go to 6 different banks and transfer money and do that kind of stuff. They like to offer that related services. They generally will charge you a fee. They won't pay a lot of interest, but you pay for the convenience. You're willing to do that because of the convenience. Last couple pieces on this chapter before I talk time, value, and money. Stock market represents only about 40% of the value of all the stocks out there, the U.S. stock market. Most other countries have a stock market. Even small countries like, I'm just thinking of one. Azerbaijan has a stock market. Vietnam has a stock market. So tiny countries have stock markets. Developing countries have stock markets. So then you have large stock markets. London Stock Exchange, the Deutsche Börse, which is in Frankfurt. You've got the Tokyo Stock Exchange, and then you've got multiple stock exchanges in Hong Kong and China. Those are large exchanges, but almost every country has a stock exchange, and there's an opportunity to invest in those countries, normally through mutual funds. You'll see like emerging country funds, and you can invest in, and they'll invest in Vietnamese stocks in the Vietnamese stock market. Most of the wealth in stocks is outside the U.S. U.S. markets dominate stock markets in other countries. We're the largest single stock market is the U.S. stock market, but most of the money is not in the U.S. stock market, it's outside. If you're an individual investor, again, not everybody in here is finance majors, won't take investments. You should have generally, academics will tell you, between 10 and 20% of your investments invested internationally. Because you want to capture this, and it tends to be a diversification from the U.S. economy and the U.S. markets. So don't forget, as dominant as the U.S. market is, as dominant as U.S. financial markets and stock markets are, we're a fraction of the world. And it's important that when you're investing, or if you're looking to raise capital as a business, that you go outside the bounds of the United States. We've tended to be far more regulated. You probably feel a little bit more comfortable investing in the U.S. stock market than you do the Cambodian stock market, or even the South African stock market, or the Brazilian stock market. Those countries developed later and are continuing to develop regulation around their stock markets to protect investors. Here in the U.S., because of the Securities and Exchange Commission and a regulation we talked about on Monday that was put in place largely through the 30s, and then again after the financial crisis in 2000 with Sarbanes-Oxley, we've got a pretty transparent investment market and one that's well regulated. We've also tended to do a lot of regulation in our financial institutions because so much of the country's wealth is tied up in it, individual wealth as well as businesses. I just hit on two major crises, financial crises that hit. The Great Depression, and then you saw all the Securities and Exchange Commission stuff kick up in the 30s. We had the 2000 financial crisis, and you saw Sarbanes-Oxley kick up in 2000. When financial markets crash, Congress gets involved. Why? Why do you think Congress gets involved when the markets crash? Major effect on the economy. Even more importantly, taxes. People get torqued off. Voters lose money. And they're like, do something. You got to do something. I lost money. I was cheated. Congress gets reelected every 2 years if you're in the House of Representatives, every 6 years if you're a senator. And voters have long memories if they've been hurt. And so when people lose a lot of money, Congress gets involved because they want to get reelected. Do something. Okay, we're going to do something. We're going to put in new regulation. When things are going well, what happens? We're overregulated. The government's too involved. Stop doing things. And so Congress backs off. And then they back off maybe too far. The market crashes, do something. And we go through this vicious cycle of regulation, deregulation, regulation, deregulation. You can also tend to see this in election cycles where you tend to see Democrat, Republican, Democrat, Republican, Democrat, Republican, regulation, deregulation, regulation, deregulation. It tends to be because voters get irritated when they lose money. For those of us who are old enough, which is probably just me in the room, the 1992 presidential election it's all about the economy, stupid. And that was the Bill Clinton mantra. It's all about the economy, stupid. And the voters will tend to drive this because we feel it in our pocketbooks and we either want the government to do something, and if they're doing too much, we feel it in our pocketbooks and we want them to do less. So if you look historically, you can see that this has occurred. And when you're looking going forward, because we're finance folks, you'll feel it, and you'll be able to anticipate it and start moving in and out of various investments in anticipation. Any questions on financial markets, intermediaries, and their roles? All right. I'm not going to throw out more PowerPoints. I'm going to talk just for a few minutes. We're about to get into the meat of the math for finance. And before we get into the meat of the math for finance, I wanted to take the rest of this class to try and get you around the concept, the why of the math. Because if we can boil down the why and kind of understand why we're doing the math, what the math is supposed to be getting us to, and a common sense behind it, it's probably going to help when you're doing some of these problems or when you're trying to think about how to approach a problem, on how to deconstruct it and work through it. We're about to move into time value of money. And as I said in the first class, time has a money value, money has a time value. We talked about that a little bit. I'm going to leave you with I'm going to give you a finance maximum outside of that one. It's something to remember as we go through, and then we're going to talk about the two components, and then I'm going to let you go. The first one is everything in finance, everything we're going to calculate, everything we're going to compare, everything we're going to do mathematically in this class and in the real world boils down to this. We are trying to figure out the value of something at a point in time. And that value is driven by two things. Anybody want to hazard a guess what those two things are? Interest rates and perceived or estimated future value. Demand is actually is a component of how the interest rate's determined. Because demand, and so I'm going to dive into each one of those. I'm going to take perceived future value first. What do we care about in finance? Cash. What we want to understand is what is the expected future cash flow? What cash can we expect coming in the future from this asset? What cash are we going to get? That's number one. All we care about at first is how much cash. A lot of what you do with ratio analysis and with this analysis that you're looking at historically and pulling all these pieces apart and looking at this project or that project, all we're trying to do is use sophisticated methods to try and come up with how much cash are we going to get in the future. Most of our modeling in finance, most of the work that you guys who are finance majors are going to do is going to be, how do I figure out how much cash is going to come in from this stuff? What we're going to spend most of the rest of the semester looking at is, how do we figure out how much cash is coming in from this stuff? And what was the second piece?
Interest rate.
Interest rate. What do you think interest rate represents?
How much the Federal Reserve is lending out to banks to act as intermediaries to fund these businesses.
That's one tiny piece of it.
How much cash can I income my cash?
That's part of it. Interest rate is the intersection of all the components of risk. And we're going to dig into each of those components. But at the end of the day, it comes down to interest rate is driven by supply and demand. And the demand is driven by how much risk, what's the return demanded for the risk that's being supplied. We can't get away from economics in here either. And so what we're going to spend a significant amount of time on, if I could summarize the next 12 weeks of the semester, it's how do we take this cash and how do we figure it out? And then how do we figure out how much risk is here and what are the pieces of that risk? How do I translate that into supply and demand and how do I turn that into an interest rate? And then how do you marry those two things together to go, for this amount of cash and this risk, it's better than this amount of cash and this risk. We truly will be able to take a stock and a bond and go, this one's better than that one because we've analyzed the risk and we've analyzed the cash. We could take a barrel of apples for resale and a barrel of oranges for resale and go based upon this level of risk and this level of cash flow, I'd rather have apples and oranges. Truly, we could calculate and compare apples and oranges in this class. So as you kind of dig into, and I would encourage you to take a little bit of time over the next day and a half to look at chapter 4. If you can get your head around chapter 4 and the Highline Community College Excel videos that are in Moodle, if you can get your head around those two things, next class what we're going to do is I'm going to fire through the first part of chapter 4. We're going to start looking at some Excel. I want to make sure that you guys are comfortable with these formulas. I want to make sure you're comfortable with Excel. I want to make sure you're comfortable with the concepts. If you can come out of chapter 4 being able to do the net present value, future value, payment calculations, those things from Excel, the math becomes very simple in this class. And Excel is your friend. If then we can understand how to combine the Y's behind each of those components, which is really just a cash flow and an interest rate, the Y's behind each one of those, you've got fundamental finance down. And that's our job in this class, is to get fundamental finance down. Any questions on that? Because I'm going to continue to ask you over and over again. Matter of fact, probably just put a slide up and put it over and over again at the beginning of every class. This maxim: the value of any asset is the expected future cash flows for that asset discounted at an interest rate which accounts for the risk. Any given asset, the value of any given asset is the expected future cash flows generated by that asset discounted at an interest rate that accounts for the risk. If you think about finance in those terms, that gets you 75% of the way through the class. And we're going to spend the rest of the semester talking about the whys of each one of those. Any questions? So we started late, we ended early, just a couple minutes. If you have any questions, come see me. Otherwise, I will see you on Friday. Be prepared to dive into this, because this is the heavy duty stuff. Yes, sir.